Welcome in everyone to this week's Social Security class and webinar. I'm your host, Matt Goolsby, host of Retire Hour, the weekly radio show. But in this week's class, we'll be sharing with you the common mistakes that we see oftentimes when it comes time for Social Security. And not only do we see mistakes there with Social Security, but we also see tax mistakes. And we'll be covering a lot of those topics today. And if you need help with any of those things, feel free to click the link below, or I believe it's that gold little phone. You'd be more than happy, or we'd be more than happy to set up a time with you to chit chat with you by phone or virtually across Zoom or any other digital platform you guys may have. So we're not with the Social Security Administration. So who are we? Well, we are an independent group called Market Advisory Group. And that group is a group of financial advisors, estate planning attorneys, Medicare professionals, healthcare professionals, and tax advisors. And we work together as a team, all under one roof around the same conference table, so that we give our people that we help clarity in retirement, never having to refer them other places. We have offices across Kansas and Missouri, but again, if you don't live near any of our offices, or if you can't make it into any of the offices, we're more than happy to reach out and meet with you virtually in this day and age. So when we meet with people on a regular basis, we find that there's a common theme to maybe the concerns that they're coming in and asking, and maybe it's some of the same concerns you might have yourself. And when I meet with people that either attend this class in person or online, or they've seen our television or our radio shows or read our publications, whatever it is, when they come into the office and they hear me ask, well, what are your concerns in retirement? They list off, well, I'm confused. I don't know when I should start drawing my Social Security. So we'll talk about different options today, but really everyone's situation is different, and I would encourage you to come in and talk through the options and the scenarios you may have in your situation, because it's like I mentioned, everyone's situation is different. And if you're not having that tailored conversation, what could you be missing? What could you be overlooking? Another concern that I hear frequently from people that are not getting tax advice with their investment or financial advice is, I'm afraid taxes will eat up too much of my retirement savings. Matt, when we filed our taxes, we owe, and we weren't expecting this, and we weren't understanding how Social Security has its own little formula that it can change the taxation of how much you're causing taxes to be paid on your Social Security. And if you're not paying attention to that, it could be costing you. And you need to be working with a team, and we'll talk about that. I need to begin taking income from my retirement account, and I don't know how to do that. You know, again, it gets back to the simple fact of when you were working, well, you had that paycheck, right? And when you're going to be transitioning into retirement, there's going to be the Social Security check. And will you only be able to live on just that Social Security check, or will there need to be other funds taken out to supplement that? And we'll talk about how that can have an impact on the taxation of it. Speaking of, a lot of people don't have any kind of plan in place. They're kind of winging it. And if you don't have a plan, I encourage you to get one, because if you don't have a plan, how do you know if you're doing right? How do you know if you're doing well? How do you even know if you have enough money? How do you know if you're not spending enough money? How do you know if you're having a tax problem? There's so many things that you can be unaware of if you don't have a plan. This is one of the tools we'll use in our office. It's not our only one, but different pots of money have different tax rules to them, and all can play together either in harmony or they can play together in disharmony. We'll talk about today how the Social Security benefit, it doesn't get treated just like ordinary income. I mentioned earlier, in fact, the Social Security taxation formula, it's based on how much other income you have. And when you have other income, it can change the taxation for the negative on your Social Security. And you don't have to be like Warren Buffett or Bill Gates. You don't have to have incomes of hundreds and hundreds of thousands of dollars a year to get caught up in this trap. I'll share with you all an example later in this class about a gentleman named Mark. Mark actually takes $1,000, just $1,000 out of his retirement account, and it almost triggers, in a way, double taxation. And I'll share with you all again later with this in this class. But again, if you don't have a plan and you'd like to come in and at least talk about these things, we'd love to set this up with you one-on-one. Another concern we'll hear is, well, I'm frustrated. I don't get answers to tax questions when I ask my financial advisor, or I can tell you this, Social Security will not be helping you with any tax planning or any tax questions. They may help you with tax withholdings, but do you know if you're withholding too much, not enough? Or again, do you even have taxation on your Social Security? We'll get into that here in just a little bit. I cannot afford another market crisis, and I don't know what strategy will protect my retirement when that happens. Had someone in my office just the other day, they said it so well. They said, you know, Matt, when we were working and saving for retirement, then that's a different philosophy. That's a different investment mentality because we're still earning money. But now that we've retired, this is all we have. And if you're not having some kind of strategy or plan there in place, you may have to just rely on just your Social Security. If there would be a market big correction or a wipeout, you don't want to make investment mistakes there, folks. Make sure you do have a plan. So one of the big questions I get when it comes time for Social Security is, well, how are my benefits calculated? I could spend hours upon hours and put you all to sleep, even maybe more than this probably topic will do to begin with. But the thing is you need to know that it's the top 35 years of your work history adjusted for inflation. That's how they arrive at what's called your average indexed monthly earnings, or your AIM. We'll talk about it or refer to it a lot as your primary insurance amount or your full retirement age benefit. So many things are driven off that full retirement age benefit, not just yours, but oftentimes spousal benefits, disability benefits. So many different things can be driven off that. And if you don't know your full retirement age benefit, you need to know that number. And speaking of full retirement age, you need to know when your full retirement age benefit is, or excuse me, how to determine what your full retirement age is. And we'll cover that here in just a little bit. If you haven't set up your online account at Social Security or ssa.gov/my account, I encourage you to do so. Very, very beneficial. Not only can you track your earnings history on there, you can also pull off what your full retirement age benefit would be there on your Social Security profile. But if you haven't set up that account, I encourage you to do so. You can file for Social Security through there. You can start your Medicare through there. You can see tax documents, any correspondence. I really encourage you to set this account up there at ssa.gov/my account. Once you've set up your account, you can go online and research that benefit information. So again, create that account, research your earnings history. I mentioned that earlier. That's important to do. You have 3 years, 3 months, and 15 days to tell Social Security, hey, there's an error here on my record, and you need to input different numbers or change it, or I need to get you some documentation to show you that I actually did make money that year. Because again, how they determine what you will receive in Social Security benefits is calculated on the top 35 years of your work history, okay? So you can go in there and not only research your earnings history, but view your benefits and see those statements. Because if you're gonna have questions on when the best time to maybe take your Social Security, or when should you start taking your Social Security, then you wanna say, well, I need to know what those numbers are. Because if you're just guessing, or if you're not knowing what those are, it's hard to come up with a plan, okay? So start here. Then again, I mentioned earlier, your full retirement age. You need to know what that is. Well, that's not necessarily when you retire. Might not even be per se when you start your Social Security. But your full retirement age, it's based on the year you're born. So we take a look here at the screen. A large window is between 1943 and 1954, okay? That would make your full retirement age 66 years old, okay? Every year after 1954, so say if you're born in 1957, you're gonna add 2 months to the age of 66 until you're now your full retirement age being 66 and 6 months, okay? So after 1960, there's no adding 2 months, it just caps out at age 67. So most people that we're meeting with right now, they're actually born between 1957 and 1960. So again, your full retirement age will be closer to 67, maybe even 67. And sometimes people think that full retirement age is the age 65. And no, that's when you're eligible for Medicare, okay? So after we figure out when your full retirement age is, that's an important age to know, because if you plan to start your Social Security and work, and I mean work like continue to get a paycheck that you're paying FICA taxes on, so if you're self-employed, it's anything that you're paying the self-employment tax on, you need to make sure that you're not going to be going over those dollar amounts. Because if you start taking your Social Security earlier, say age 62, as early as you can on your record, then you're thinking, well, maybe I could go back to work and I can double dip. You can't do that unless you've turned your full retirement age, unless you stay under these annual limits, and they bust them up monthly. But we're going to take a look at 2025's numbers. So if you're going to start collecting your Social Security and work, so say you're age 62, you cannot make in the year 2025 from a job as an earned income, anything again, you're paying that FICA tax on, more than $23,400 in income. All right? Now that means $1,950 a month in working wages. That doesn't mean if you take $23,000 out of your IRA. That doesn't mean if you win the Powerball or the lottery and it's $23,000. That is not what the CPAs or the tax advisors call earned income. And you need to understand there's a difference here. Now, in the year you turn your full retirement age, which is why it's so good to know and calculate out what calendar year do you turn your full retirement age, they increase that number substantially this year. So 2025, the number is $61,260, or works out to be $5,180 a month in working income. And sometimes that does allow you to sometimes keep working and double dip with your Social Security and maybe pay off some debt or pay off some mortgages or build a little cushion if, God forbid, you're only going to be living on just your Social Security. But these are just the ins and outs of all these programs, and it gets so confusing if you don't have someone that can help you and tailor you with these questions. And we'll be happy to take a meeting with you, and maybe if just 15 minutes by phone, and just answer any maybe questions you have, or maybe better yet, if you live near any of our offices in Kansas or Missouri, you could come in and meet with us one-on-one there. But after you've turned your full retirement age, there is no penalty. Now, hear me out, guys. You still have to worry about taxes. Taxes are different than this. I know every time we get like a penalty or we have to give money up to the government, that gets confused as like a tax, but there's a penalty for breaking the rules of the program. And understand taxes, we're going to talk about a little bit later, but a lot of people will get this, like I said, confused with taxes, and you don't want to get this confused. So let's talk about this example here of what would happen if Susan, who would be age 63, so we know that's nowhere near her full retirement age, right? So she's eligible this year for $16,500 in Social Security benefits. Well, here's the problem. Susan's still working. She's making from her job $50,000 a year. And I've seen this mistake happen a handful of times. And we help people navigate them through that. And you have to understand, if you don't get these rules before you start these programs, there are so many unintended consequences here. Because Susan is well over 2025's earnings limit of $23,400. So she has what's called an earnings excess of $26,600. Now, I'll admit, I'm a kid from Kansas. And it took me a while to kind of simplify this, because I've mentioned the governments, they've got their own rules and their formulas here. And the technical term, I believe, if I'm quoting it correctly, in this scenario, it would be, well, for every $2 you go over, you owe them $1 back. And just being a simple kid from Kansas, going to Goddard High School growing up, that took me about 12 months to say, well, gosh, isn't that just a 50% penalty? Why does the government have to make things so confusing, so complicated, and so frustrating? Well, a 50% penalty here in Susan's case would have cost her $13,300 back, so she would have netted $3,200 in Social Security benefits. Good deal, right? No. Not only did Susan turn on her Social Security earlier, so she received a smaller amount for the rest of her life, but then she owed most of it back in the form of a penalty. And you don't want to have this happen, guys. And like I've said, I've seen this happen a number of times. One of them that comes to mind was someone that was laid off. They started their Social Security up and then they went back to work and they didn't understand the rules of the program. I will say Social Security does a great job at trying to avoid this or avert this from happening, but they can't catch everything. So I mentioned the longer you wait to file, the more you receive in benefits the rest of your life. I mean, I think that's pretty, or maybe a more correct way to say that is The longer you wait, the higher amount you may receive monthly for the rest of your life, okay? Because you never know when or how long you're going to live till, right? But the longer you wait, typically it's going to increase your Social Security payout and the monthly amount. In this example, this is someone with a full retirement age. Remember, there's different full retirement ages depending on when the year you're born. But in this example, in a full retirement age, they're 66 and they're eligible for $2,000 a month in Social Security benefits. If they take it as early as possible, age 62, it would be a 25% reduction from their full retirement age benefit. Now, if your full retirement age is 67 and you take your Social Security age 62, it is a 30% reduction. Here's why. Every month you take your Social Security earlier than your full retirement age, it's a fractional reduction. Or maybe let's say that the other way. If you take your Social Security later, every month you delay taking it, it's a fractional increase from where you could have taken it at age 62, okay? Now, in this example, I'm showing here someone's full retirement age is $2,000 a month. I want to give the disclaimer here of by no means am I saying go out and file for your Social Security as early as possible. Again, hear my heart, that's not what I'm saying here, okay? I'm telling you that this is part of a bigger puzzle, it's part of a bigger picture, but I want to share with you what I've observed here because it's interesting. And I just want to highlight it and point it out here, but I'm not telling you just take it as early as possible. No, it's part of a tax conversation, it's part of an income planning conversation, it's part of a spousal conversation. So many other factors go into this. But take a look here. At age 66, $2,000 a month, and at age 70, an extra $640 a month. Well, how much in Social Security could you collect in these 4 years? Well, if you had a birthday in December of the previous month and started your Social Security in January, well, the most you could receive in a year in this scenario would be $24,000. So let's say $24,000 times 1 year, 2 year, 3 year, 4 year, that's $96,000. How old do you have to live until $96,000 totals, or this $640 a month totals an extra $96,000? And it works out to be about 12 and a half years, guys. And if you don't think about these things before you start your Social Security, you could be overlooking different scenarios, circumstances, or God forbid, even financial catastrophe. I've seen that happen several times here, as far as people coming in having made Social Security errors and they're hurting themselves and they don't even understand it. So will my benefits be taxed? The answer is, it depends. Kind of sounds like a politician, right? Well, it depends based on what other income you have. And if that other income reaches a level between these different tiers, and then also half of or 50% of what you're collecting in Social Security benefits in your household or on your tax return, then you may trigger taxes, you may not. They look at you as an individual or married couple. So let's take a look here and remember these ingredients, because that's the key. The ingredients are all the key to this formula. There's one kind of retirement account. We're not going to talk about it in this class. We talk about it in one of our tax classes. There's one retirement account that doesn't get taxed. It doesn't get counted towards this formula, and it helps a lot of times when it comes time for tax planning and can even save people money. So these ingredients that go into this formula are half your Social Security and then your other income. Could be if you're still working, or if your spouse is still working, if you're going to be in a married scenario here. If you're taking money out of your IRAs, if you have pensions, if you have stock investments, interest from the bank. We see this all the time, our tax advisors, and we help people fix these issues. But people that have money markets or CDs at the bank, they're very conservative, and they might even be on Social Security, but it's causing them extra taxes on their investments because of how this Social Security formula works. Again, I'm going to show you with that example here with Mark here later, how that $1,000 that he takes out of his account, it costs him almost double taxation. Who wants to be double taxed? So often, people figure out after they've done these costly mistakes. And if you're not getting tax advice before you do these things, how do you know you're making the best decision for yourself? So these ingredients, again, half the Social Security and the other income. An individual, They look at once half the Social Security and the other income goes over $25,000, you've now started to trigger some taxation potentially on your Social Security. Sometimes you still see the standard deduction help people with that right now. That's why it's so beneficial to go through tax planning every year with us. Now, in the second tier here, once half your Social Security and your other income goes over $25,000, you're up to this $34,000 tier. Half of it's counting as taxable income in here. The tax rate's not 50%, it's just half of the income that's in this tier is counting at whatever tax bracket or rate you're in. Once it goes over the $34,000, then 85% of it gets taxed. And what's going to happen here in this later example, I'll tease this that's coming up. Mark will take $1,000 out of his IRA, extra money just to go out and have some fun and vacation, and he has no idea what it does to him in taxes. This $1,000, it has like a domino effect, or it funnels all through here, and 85% of $1,000 is $850. So he'll owe the tax on the $1,000, and he'll owe the tax on another $850 of his Social Security. That's why I call it double taxation. And that's why I mentioned earlier, you don't have to be Warren Buffett or Elon Musk or Howard Hughes. I think he's actually passed away. That's a personal joke. But I don't think that you have to be a multi-millionaire or the uber rich to get caught up in this trap. In fact, I think it hits middle America more than it hits anyone. Because the married tiers, they don't double them like they do with tax brackets. You know, you see with income tax tables, they'll double those numbers oftentimes. Well, the thing is here, once half your Social Security and your other income as a married couple goes over the $32,000, now you've triggered some taxation on Social Security. Once it goes over the $44,000, now again, you're in the same situation we were talking about that we're going to talk about with Mark, where 85% of whatever you're taking out is causing some double taxation on your Social Security. And you need to make sure you know these things before you do these taxable events. So we have Mark here, and this is this example. He's retired and he has a taxable income of $42,475. Now, why I do the air quotes and say taxable income is because he has other income. It's just not all being taxed. Let's take a look. $38,000 is coming out of his retirement accounts, his 401k, his IRA, wherever, to supplement the $25,000 he's collecting in Social Security benefits. Now, remember that formula, half of Social Security plus the other income, then look at the tiers, individual or married. Isn't this all fun? This is why we meet with people on a regular basis to help them walk this through in their scenario. And if you want to know more about that, click the link below. We'd love to have a 15-minute phone call with you to see if you could benefit from going through some of this tax planning. But back to Mark's situation. So this is just his baseline. But most things don't stay static. You guys go and do things in retirement. You go see the grandkids, you take trips, you do projects, you remodel the house, you fix things up, you have life happens, and you need to take some extra money out. Mark, he wants to take a vacation, and he wants to take this $1,000 out. He says, well, I'm going to call my financial advisor, and I'm going to have him send me some money just to go on this trip with my buddies, and so I can have some gas money or some money for the hotel or whatever, just pocket money so he can go enjoy it. Calls up his financial advisor and says, hey, can you send me $1,000? Well, sure, Mark. Do you want us to withhold taxes? Yeah, I think I need to withhold taxes. I don't like having taxes hit me come tax time. How much should I withhold? Well, Mark, we're your financial advisor and we're not your tax person or your tax advisor. Isn't that so frustrating when they answer that way? But believe it or not, that's how they're supposed to answer. That's why we think the retirement system is broken in America, because all these different professionals are spread out and you don't stand a chance because it's your responsibility to relay all that information out there. And you just want to be retired. You didn't want to change jobs. So how much does Mark owe on his taxes? Maybe he has a tax advisor. He calls him up, plays phone tag with him, has to call up back his advisor, does whatever. But maybe there's something that gets missed in translation. Maybe there's something that gets missed in all the chaos of the phone tag back and forth. Maybe Mark doesn't have a tax person. Maybe he just goes to the internet and searches, well, what is the tax brackets? And, maybe that year he was in a 22% tax bracket. He says, well, I guess I'm in a 22% tax bracket. Go ahead and withhold 22%. And he's partially right. He does owe 22% on this $1,000 withdrawal, But the problem that Mark will not figure out until it's too late, until he goes and files his taxes and he figure out he owes or he miscalculated or did something, he also owes 22% on another $850 of his Social Security. Some of you are like, what? Well, let's take a look under the hood. Again, the only difference in the physical income, the only physical difference that Mark takes in his hand is $1,000. But that changes his AGI, or what stands for adjusted gross income, his taxable income. And it's going to change it. That extra $1,000, only $1,000, it's going to cost him in taxes of $1,850 at 22%, which is $407. So it's not like he's in a 22% tax bracket. It's like at this point, again, just around $60,000 in income, he is in a 40% tax bracket. How on earth could you know this working with a financial advisor that doesn't help people with tax planning? It's an area of high concern, and it's probably the area we see most people making mistakes out there. And things can be done about it, but you have to be getting tax advice with your investment advice or your income advice. And if you're not doing that, guys, again, we'd love to schedule a time with you. Click the link below. IRMA is a whole kind of different tax. I consider it like a sneaky tax. I had a teacher here in the Wichita metro area that I helped her with her retirement plans. And Marcia, I wish she would have came to us just 1 year sooner, because the tragic thing is the next year was when we figured out all this had happened. All of these issues, if you didn't catch that, had been happening at her previous financial advisory firm, where she wasn't getting tax advice, where she wasn't getting the help with her healthcare or her Medicare decisions. This is a team sport, guys. And if you're not having these collaborations, these cooperations between the different professionals, it's really your responsibility. Back to Marcia. Marcia, when she retired, she was fortunate enough to have a pension. She was a retired teacher here in Wichita. She also was taking some money out of her account to supplement her Social Security. She came to one of our tax classes, and I remember when I met Marcia, she said, I have a tax person and I have an investment person, but they're never talking together, and I think it would be better if they did. And so it was. But the problem, it was a year too late for this story. Marcia, about in October, November, she got a letter from Social Security. It said they were going to reduce her Social Security benefit starting in January by around $75. She picks up the phone, she calls me, and she goes, Matt, I don't understand. There's this letter from Social Security. And I said, well, Marcia, can you bring in that letter? And when you come in, Marcia, we had not had a chance to do her tax return. She was a new client that year. I said, we have not been working on your taxes yet, Marcia, so can you bring in the past 2 years of your tax returns? I want one of our tax advisors to see some things, because if they see what I think this may be, we need to have a conversation, Marcia. So she comes in, she brings these letters in the 2 years of tax returns. CPA, Joshua Sikora, looks through them and then points at a line. And I said, Marcia, I know what your income is this year, but did you have a larger withdrawal before you're working with us? And she said, yes, I took my grandkids on vacation. And when I took my grandkids on vacation, the advisor, he helped me withhold the taxes, so I should be okay. Maybe, but maybe not, Marcia, because did he talk to you about what IRMA is? She goes, I don't know what IRMA is. IRMA is an acronym. It stands for Income Related Monthly Adjustment Amount. And if you trigger it, and the amounts change year by year, if you trigger it by just 1 penny, it could start adding extra costs to your Medicare. And they'll just withhold that from your Social Security check. Marcia was upset. She had no idea. You need to make sure you're communicating these income amounts between your financial advisor, your Medicare professional, and your tax professional. Because if you're not, it's your responsibility. And I mentioned earlier, that's not a responsibility a lot of people enjoy, let alone want, because they want to enjoy retirement. That's what they've saved. That's what they've worked so hard and sacrificed so hard for, and that's what you deserve. You don't deserve to trade one job for another. So Medicare, taxes, forfeiture, all these different things and more to worry about Social Security. And if you want to come in and talk about more, if maybe there's some things that are going on in your situation, again, click that link below. We really encourage you to come in and just have a conversation with us, just a chat. So some takeaways today: know your filing plan before you go file, before you start talking, because you need to make sure you're knowing all these things. You need to make sure you're looking at the tax consequences, the healthcare expenses, your income plan, your longevity, all so many factors to consider in. Knowing if and when and why you're going to file usually depends on so many factors like we've mentioned, and you need to understand what those ramifications are. The tax laws, I'm going to say the tax laws will always be changing. We are seeing a new government installed this year. The Republicans are in control of the White House and Congress. Hopefully we have tax reform passed. And if that's so, you need to make sure you're taking advantage of those tax reforms and maximizing those tax savings for your situation. And if you don't understand that, you need to make sure you're being proactive with your taxes. Every year, my clients, I strongly encourage them to go through tax planning in the fourth quarter of the year. October, November, and December, we focus on tax planning, adjusting the withholdings, recognizing opportunities at the end of the year, making contributions, selling some positions, realizing some gains, doing all the necessary tax tweaks that are so key to making sure you're managing your money and your wealth to the maximum potential. Your personal tax map or situation, it's going to greatly vary based on other circumstances. And if you're not understanding what those are, I say this a lot of times on our radio show, we meet so many people after the fact when it's cost them a lot of money. Why we're so focused on education is because we want to make sure you don't make these mistakes out there. We want to prevent you from having those costly mistakes in retirement. And because everyone's situation is so different, you have to understand the impact of Social Security taxation. When you start it, how will it be taxed? Will it be taxed? Will there be opportunities if you don't start it for your tax planning situation? It's your money. You have the right to know what you're paying for your investments too without becoming a financial expert. I didn't talk about this much at all today because we focused on Social Security, but just let me take this time out here. If you're paying more than 1.5% to 2% in fees, you're probably overpaying for your retirement advice. Because if you're not getting tax advice, if you're not getting help with your estate planning questions, if you're not getting help with your healthcare advice on a yearly basis, then what are you paying for? So often we see that people are overpaying for the advice they're getting. And again, if you want to walk through our MAG report process, click the link below, or again, that little gold phone down there. We'd love to have just a chit chat with you by phone to see if you really could benefit from going through our full-blown process. And that's what we want to have there. We're a very transparent firm. We have all of our fee structure listed right on our website. You can go check that out at marketadvisorygroup.com. While you're there on marketadvisorygroup.com, you can check out the past articles. We've been in Money Magazine, we've been in Wichita Eagle, Kansas City Star, Kansas City Business Journal, so many different publications. We have a weekly television show called Eye on Retirement. I mentioned earlier, my baby is retirehour.com, our radio show. And if you don't catch that on the radio show on the weekends, feel free to go to retirehour.com, check out past episodes, or better yet, submit a question to be used on the show. If you provide your address, we'd love to mail you out a little thank you there for providing that question. We've written a couple books. One called The Investor Catch talks about fees and risk and who's poised to profit more, you or your financial advisor. And I mentioned this earlier, if you're paying 2+% a year in fees, and I see it often, you don't need to be paying anywhere near that. And if you don't know what you're being charged, again, come in and go through that MAG report process with us. We'd love to set you down and do an analysis. That MAG report, it stands for Market Advisory Group, Retirement Evaluation Process, Other Risks, and Taxes. We talk about how there's so many different risks in retirement in this book called The Investor Catch, and how, I don't want to sound conspiracy theorist here, but I think the retirement system, I mentioned this earlier, is broken. It's set up so fragmented. So many people are afraid of being sued or don't have the right licenses. And then you're out there to just survive on your own. And we don't want that. I and myself and our team do not want that to happen. That's why we do all these things, including writing our books. One of our estate planning attorneys wrote The Inheritance Trap, Common Estate Planning Mistakes and How to Avoid Them. You need to make sure you're reviewing your estate plan documents on a regular basis. The laws change. A lot of times financial institutions will want those power of attorneys more recent or signed within a 5-year period. It's kind of silly anymore, but you need to make sure you don't set it and forget it with those estate plans in retirement. Our offices, I said, are located across Kansas and Missouri. If you don't live near any of those, well, we are taking meetings virtually, Zoom or Teams. We'd love to have a conversation with you, talk about your Social Security questions or anything that could be going on in your situation. So again, follow that link below, or again, reach out and schedule there a time on our office. Well, that's all the time we have this week. Thank you for tuning in. Don't forget to check out our other webinars and our other classes here on the website. Thanks.